but for everything else, you need it. Oh, recording.
You're good.
All right, good. All right, so I really kind of want to talk a little background on myself. I got into lending back in 2004. It was a different world back then. I was 21. I did not know anything whatsoever. I also owned 9 rental buildings. I bought my first 6 flat in 2004. And real estate at that time, it was only going up, right? There was not a crash coming. And so I was 21. I owned a 6 flat, and then I bought a 9 flat, and then a crash happened. And so I had to figure out how to pivot my business and my life. And fast forward, now I own 9 rental buildings, 52, 53 units. I haven't been heavy into buying rental buildings in the past couple of years because lending has taken so much of my life and my time. But I do about 400 loans, 450 loans a year as a lender. A huge portion of my financing is multi-unit investors, coming up with a game plan and figuring out how to get people to grow. That's pretty much what I do. So let's talk about lending in a post-COVID world. So, 2020 started out awesome. And then we heard this thing about this virus coming through, and it reset not only our minds and how we viewed things about this pandemic, but it also reset lending. Lenders became really, really scared. The programs we knew before did not exist. All of a sudden, COVID happened, and there was reasons why that happened. We had massive, massive job losses. And so this all happened in a 2 to 3 week span. This was not 2008, 2009, where it was like the train's coming and you can see it, but you couldn't figure out how to stop it. But what was different about COVID is that the people who lost their jobs were not necessarily homeowners. So real estate did not suffer as much as they thought it initially would. And so that's where we all had to figure out how to adapt to this and how to navigate through this. And so one of the biggest things that kind of changed lending is the forbearance deferment. And I don't want anyone to raise your hands, but there are probably people in here who had to do deferment or forbearance. And if you don't know what that is, just basically you had a mortgage and the federal government came out with this program where you didn't have to pay the mortgage. And so at one time in our country, this was just in July of last year, we had 8% of our mortgages deferred. That means 8% of the people who had loans were not paying. Maybe they couldn't pay, maybe they just didn't want to pay, or maybe they just wanted to just have some time off and save some extra money. So what happened in the mortgage world, why actually rates weren't as low as what they should have been, is that remember who owns these mortgages. It's not the banks, it's your hedge funds, it's your mutual funds that buy mortgage bonds. And so who had to make those payments on those mortgage bonds in the beginning? That was your Bank of Americas, that was your Loan Depots, that was your guaranteed rates, that was your other companies had to physically pay the bondholders, or what's going to happen to your portfolio. Prices are going to come down because people aren't paying on their debt. So what did lenders have to do? Lenders actually, even though rates were lower, lenders raised their fees and raised their rates to offset all the people who might not pay or who were not paying. And it took time to work that out. So where did they start pulling back when everything kind of crashed all at once? It was your FHA financing, so your low down payment, low credit scores. They put extra rules and extra guidelines on there. It was if anyone tried to do a cash out refinance last year and had a hard time in the beginning. Why is that a hard time? Well, if people are losing jobs and we don't know the value or what's happening with real estate, if you want to increase your loan amount on that, that's higher risk. So lenders were pulling back all these programs that they normally had, and we had to figure this out. And investors had to figure it out because there were still opportunities to be had, but we had to figure out how to leverage ourselves in a different way. And then what was also going on at the same time, if any of you guys were landlords caught holding the bag, is were you not getting paid, right? Like did any of you guys have tenants who were not getting paid? And we can talk to her blue in the face. You got, stimulus money or unemployment, you weren't paying your rent, right? Like we can talk about that till we're blue in our face, but landlords were really beat up through this pandemic, and so it turned off a lot of investors. But the bottom line is with investing is that our population isn't getting any smaller. We have a new housing supply that's being killed right now by high lumber prices. So existing housing supply is supported now because the new developers don't want to build as many houses because now they got to worry about appraisal issues. If their lumber is 25,000 more per house, that doesn't mean the value is going to be 25,000 higher. So the new home builders are requiring larger down payments. So this is where the existing housing supply has really benefited over the new construction housing supply on that stuff. But landlords, we got the short end of the stick. I was very lucky, and I think, John, how many tenants did not pay you through the entire process?
About 62.
So 3, I had 0 who didn't pay. I had 1 person who was a slow pay, before COVID. But I have clients who I own a 3-unit, not one client, not one person was paying. And so the advice I give the landlords is, do the right thing with your tenants. If a tenant is not paying, forget the eviction process right now. Courts are backed up. The moratorium is coming off in Cook County. Give them cash for keys, get them out, get the unit, get someone better in there. Because you don't want to get caught for another 12 months of a tenant sitting there while you're waiting for eviction. Forbearance, deferment, a lot of that also required tougher credit scores. So if any of you guys tried to get loans or you notice that the interest rates you find on the internet and then your rate you actually get are vastly different. There's a reason for that. The agencies added on a lot of risk adjustments to the pricing. If you're doing a cash out, if it's a multi-unit, if it's an investment property. So really the rates are really, really low for primary residence people. But when you get into the landlord world, they're okay. Rates are good, costs are a little bit more. That's been the biggest change too with that. So does anyone know what the government is actually doing on how they're keeping rates low? Does anyone kind of read any of those articles on why the government or what actual thing are they doing to keep rates low? Do you know what they're buying? Does anyone know that? Want to take a stab at that? Yes, bonds. Absolutely. So basically, all the government is doing and why rates are low right now is the government, let's just say the Federal Reserve, but let's call it the government for sake of this. They are buying $120 billion a month in mortgage bonds. It's just basically debt. The more people that buy debt, the lower the rate of return gets, thus the interest rate gets lower. So I ask people this all the time. Would you guys buy a government bond for 1.2% yield for the next 10 years? Probably not. Yeah, you can buy Tesla and make 20% overnight. I'm not saying do that or any Robinhood traders out there. But that is something that is going on. So as the government is going to start evaluating everything, and as people go back to work, they're going to take their foot off the gas and they're going to let up. And instead of 120 billion a month, maybe it's 100 billion, maybe it's 50, maybe it's eventually 0 to try to return it to normal. But if they immediately take their foot off the gas, if any of you guys watch CNBC, they talk about the taper tantrum. That's them scaling back the bond buying. Because the mutual funds and the hedge funds are not buying bonds right now. They're not buying stuff at a 10-year at 1.2%. It's not worth it. They're not buying a mortgage that could be deferred or have forbearance with only a 2.5% rate on it. Maybe a 4% they'll take it, but they're not going to take it at 2.5. So it's the government issuing debt and turning around and buying that same bond, which is why interest rates are lower. They will go up, but they have committed to keep rates low and understand as they go up, real estate's going to level off or it might come down. And we'll talk about bubble burst. I don't believe in that, but we can talk about that too. So does that make sense? Does anyone have any general questions about kind of interest rates and where they are and why they are what they are? No? Good. Oh, yeah, go ahead.
It's primarily
Fannie Freddie farming, jumbo loans, and any Freddie gold. What about non-farming mortgages? One-off financing, hard money,
Okay.
and things that aren't shifting abroad, India, or that security.
Okay, so what he's asking about is like hard money loans and loans like that. So that was a very important type of financing we had to use when COVID was in the midst of it, right? We thought we'd go outside, we thought we'd die. That was March, April range. And so hard money came into play. The only thing I could say about hard money is make sure you have an end game. It's typically 7, 8, 9, 10% rates, if not higher. Costs you a few percentage or few percent of your loan amount, and they're typically 9-month to 12-month loans. So if you are going to,
I got 36 months.
36 months or so, but probably a little bit better interest rate. And is there
7%.
yeah, so that's probably a better relationship type of banking, maybe not. I don't know, but typically that's what you kind of see in the hard money world, where they'll do things the regular lending market will not do. That does exist. Jumbo mortgages are basically, if for a single family home, any loan amount, just using round numbers, over 550,000, it takes you into different rules, different guidelines. That's physically the bank going to their own vault to lend out the money. It's not secured by anything whatsoever. There's no Fannie Mae or Freddie Mac or government agency. They're assuming 100% of the risk of that loan. Does that kind of answer?
Yeah, just, I mean, Fed rates change. The Fed was strictly buying foreign bonds, maybe a little.
And
maybe
they
a
still
little.
are. And they still are.
So jumbo loans, things outside of the Fannie Freddie farming, they dropped. And it's still going to be a taper increase on those.
Okay. So he just wants to know if jumbo loan rates dropped correspondingly with Fannie and Freddie. And the answer was, when COVID happened, no. Most lenders exited the jumbo market. So what happened is we had to do 2 loans then. We would do one at the conforming limit and then one as a second mortgage. But before, you could do a jumbo loan up to $3 million at 5% down. As soon as COVID hit, banks were worried about mortgages going bad, so they had to pull back and hold on to all their cash. So they said, we're only going to lend it out with 20% down for this jumbo financing stuff. And so the jumbo market exited. There was 60 days we couldn't even do jumbo loan. And so you had people who wanted a lower rate, but they would have to bring cash to bring it down to a conforming loan or nothing. Jumbo has come back and it's come on the level of conforming. It's not as low because they're still at 100% risk on it, but it's drastically come back in the past 4 to 5 months. It's nice to have that product. It's very important. Okay, so what I really like talking about people and what I kind of educate clients on is look 6 months out. So does anyone know how long you don't have to pay a mortgage until, not forbearance or deferment, in general, if you don't pay a mortgage for how many months, then you get foreclosed on? Does anyone know that number?
Months.
3 months, and then they can file all the paperwork. 4 months, you can lose the home. So when does deferment for forbearance end? Did anyone see the articles on that? September. So from September, you are going to have 8%, let's just say 5%. 5% of the people who have not paid their mortgage since March of 2020. Now, some people will not exit forbearance or deferment, meaning they don't have the means or the capability to exit. So if you bought a place 3 years ago, and let's say your loan was $200,000 and your payment was $1,500 a month, if you haven't paid on that for 18 months, plus never paid taxes or insurance, you realize your balance is going to be $230 to $240, you might literally be underwater. So when it comes time to September, you might say, I can't afford to have that $40,000 tacked on to the back of my loan. My payment's going to go up or something's going to happen. We will not know our foreclosure situation until February of next year. September, it ends. So you have October, November, December, January, February, out, everything's gonna get filed. There's gonna be a backlog. So it could be completely manageable. It could be a lot, but understand that banks have been hoarding cash for this moment. That's why if any of you guys had that, did anyone see that thing about, remember refinance rates were slightly higher? Did anyone see that article about them removing that charge? The federal government had a tax on refinances all last year and it was just removed and it's officially gone as of August 1st. So anyone who got a loan over $100,000 last year and refinanced paid a higher rate to someone who was purchasing with the exact same situation. And it was a cash grab because lenders have to be prepared and the government has to be prepared that if people do not exit forbearance and they can't pay, they need to be ready. We won't know as investors what's going to happen until February of next year. Now, it could be, again, completely manageable, or it could be a big influx, or it could just be literally just a little blip. But we'll know more once across the country, all those loans start to exit forbearance to see who's going to exit and what's going to be the ramification for that. Because if they're already rolling out programs where you can refinance if you're underwater. So if rates are at 3% or 2.5% and that person still can't afford that mortgage, what are you going to give them? 1% as a lender, a 0% rate? At that point, you're just going to say, give me the keys to the property, let's sell it, get our cash back and lend it out to someone else. So we have some stuff coming down. I think it'll level off real estate. I don't believe it's going to cause this burst or this crash, because the one difference from 08, 09 to what it is today is every single person had to prove they had the ability to repay. It's called a qualified mortgage. Every person had to show their pay stubs, their W-2s, their tax returns, their bank statements, whatever it was to get that loan. Where in 08 or 09, as long as you're before 08 and 09, as long as your credit was over a certain point, stated income, stated asset, no income, no asset, nothing. That was how lending was back then. So that's kind of my view on this crash. I get asked all the time, if I could predict the market, I'd be a billionaire, but I can't. So, but I just believe that we're going to know a lot by January and February, how many people will never exit forbearance or deferment, and what that's going to do to the housing supply, which might not do anything because there's still a lot of people who want to buy, and the home builders are building half as much because of lumber prices and labor shortages and all that other stuff. And their workers are demanding higher and higher wages, and it's not transitioning over to higher appraised values. If anyone refinanced or bought a place recently and your appraised value didn't come in, there's a reason why. Demand is outpacing actual values. Any questions on that? Anyone throw out some comments maybe about what their feelings on a burst or a bubble or anything like that? Inflated prices, non-inflated prices? No?
You haven't touched on it.
Oh, inflation. Okay, yeah. Inflation is a good thing. So there's this, if you watch the news or you read articles, they're talking about transitory inflation or real inflation, right? So inflation is the nemesis for bonds, bad for bonds. If the cost of goods go up, bond prices have to, or the rate of return of those bonds has to go up, right? If everyone's like, that's why you don't put your money in the CD, right? CD right now and earn, 0.5%. You can earn a lot more money doing something else. So is the cost of goods, is our gas going up because it's real, or they have to pay that trucker more money because there's less truckers available to get that gas there? Are the chicken wing shortage? Paul, you love chicken wings. He loves chicken wings. Are the cost of chicken wings going up because there's really a shortage, or there's fewer people working in the chicken coops, right? Or whatever they're called, chicken houses. We don't know that until most articles say the extra unemployment ends and we see the return to work. Or is it because they have to pay the people more money to work at those places? We know there is inflation, but we don't know if it's real inflation or it's short-term inflation, right? Like, bless you, the cost of a hotel room in mid-COVID was what, $60, $80? And now that this is the party year, now they're $500 for a hotel room. Flying down to Florida was $100, now it's $500. Is it because American Airlines canceled 6 or 9% of their flights and because they don't have people to work? Or is it real? Is the cost of fuel going up? Or is it because Boeing is years behind their plane orders because everyone canceled and then reordered again, and there's fewer planes out there now, so they have to charge more. So we'll know as the months go on, is this real inflation? Is it transitory? Or is it something we need to be worried about? And if it is, rates will go up. And it's going to have a negative impact on real estate. But I can't stress this enough. Unless you're selling, value is arbitrary with real estate. Unless you're selling. Don't stress about, oh my God, my multi-unit or my place went down 5% or up 5%. Unless you're selling, it doesn't matter. Literally does not matter. But yes, and inflation is something that we worry about in the mortgage world that you should be conscious of. Anyone get a gas bill recently, right? And the gas bill, it's supposed to be cheaper, but your delivery charge is through the roof. Gas companies do that in the summer, and then they drop it in the winter, but you use more gas, so you pretty much have the same bill all year long. But it's cheaper. So we don't know if that's real or not. So anyone got any thoughts on inflation? Want to ask me any questions on any of my other thoughts on inflation? Any of that good stuff? No? All right.
Yeah, I got it.
What do we got?
So they were saying that it was something up like 6% inflation recently.
Yep.
Do you see that as continuing, or do you see that as a blip? It's going to go back down to like 1.2 that it's been at for forever.
So there's two inflation numbers. So there's core, and then you have to pull out food and energy, and then you take a look at that. So your fixed basket of goods, your TV, your CD player, what you guys don't have CD players, MP3s or whatever. Your iPhone. There you go. Your iPhone. So the food is off the chart, right? Food has gone up, beef, all that stuff has gone up. I believe that there is real inflation, but I don't believe it's in the realm of those first few readings. Once we look at everything, I believe it's going to be probably around 2%, which the Fed and the government is set on that 2% mark, which if they're set on 2% and that's their target, the 10-year will get to 2%, which means 30-year fixed mortgage will probably get to that 4.25 range, which is probably where it's going to be. I don't know if it's going to be 6 months. I would guess somewhere late next year is probably the 30-year is going to be in that range. Or we're going to be like China, forever low rates, right? Like China's Fed has been involved in their interest rate market forever. But yeah, it is, I believe there is real inflation, because how do you come back? Has prices ever gone down on anything? I mean, besides like oil goes down, but it takes, a month of oil going down to be, reflected at the gas pump, but immediately as soon as a barrel goes up, the guys on the sign changing it, right? So
what about with regards to the amount of money that is taken from the
yeah.
And I mean, I don't think it's all just based on supply and demand. I don't know how much you know, Josh, about like, is that a real injection into the economy, or is that just so that banks have enough cash reserves?
Banks have passed any stress tests that the feds have thrown at them. So it used to be you can borrow 100x. So for every dollar you had on deposit, you could lend out 100. So you're leveraged 100 times over. The most recent thing we saw that was Robinhood, right? When they shut off trading, they allowed people to leverage 10 times, 50 times. Robinhood didn't have enough cash to make the calls because people lost so much money. All that problems happened. I think that the debt that they're printing, it's a infinite amount of debt when you're talking trillions, when, Merrill Lynch and these big places buy in tens of billions. $1 trillion, let alone 5 trillion, is an infinite amount. If the Chinese and other countries did not believe in our debt, we would be like Venezuela and some of these other countries where you have hyperinflation, where you have a wheelbarrow full of money running to the bakery to buy a loaf of bread, and it costs you $1 million whatever just to buy a loaf of bread because it's basically worthless. Our money will probably be worth less, never be worth less, because we have plenty of people who love our debt and we always pay our bonds. But yeah, it's just an infinite amount of money when you're talking $5 trillion. I think it was good, but the benefactors of it, right, were your Targets, were your Amazons, were your Nike, were your companies like that, because look at those stock prices, right? Target was $80 at the bottom of the, March, 250, 260. Your Teslas and all those other companies, those are arbitrary. But look at your Amazons, look at your Targets, look at those real places. That shows where all that money went. And the revenue some of these companies have posted is ungodly, I thought.
Feeding more into the inflation of asset prices rather than consumer.
Correct. I think about everyone who became a day trader, right? During this in the AMC and GameStop and all these things. There's articles out there that the stock market has $800 billion of actual credit, which is actually a lot less than I thought. If that money ever came out, it would take the Dow down 6,000 to 7,000 points. Now the market's $1 trillion, multi-trillion dollar, but still, those are real concerns. That is the market inflated, or is it always going to be like that, right? So us as investors, we have to say, where do we think things are going? Real estate has always been the benefactor in a crappy economy, always. So that's why I always believe in the real estate asset, regardless of the economy, and for clientele. It's a great benefactor. All right, so I'm just gonna kind of finish out on like positioning yourself. So when you guys are wanting to do loans, the idea is figure out what you want to do, have a great team, and ask for their advice. If you own real estate now, how do you leverage that real estate to get to where you want to be? Don't force buying, right? Like, you're going to be married to this property forever. Don't force a sale. Don't force to buy a place. Don't buy to just buy. That was 05, 06. People were just buying to buy. Buy to invest. This is your pension. This is your retirement fund. You're going to live in one of the units and rent out the other two. There's plenty of good deals out there. There's always someone who's going to die and the heirs get the property and they need to sell really quick, right? That's always going to happen. It's not like the deals are always going to go away, or there's all of a sudden going to be no deals left. But position yourself, leverage yourself. The big thing I tell people is, don't forget your 401k. Remember how much that thing has grown over the past 18 months. Leverage that. Otherwise, that's dead money. I'm not saying withdraw from your 401k. Borrow against it, but do it wisely. I mean, 25, 30% gains in 18 months, that's not logical. So leverage that money for something good. Use it. Many 401k providers allow you to borrow 50 cents or 80 cents on the dollar, and they'll even let you break that payment on that money up over 5, 10, 15 years. So if you're buying a multi-unit and you have this 401k money, that rent's probably going to pay that monthly payment on 401k. So that's a good asset where you can take advantage of the inflated market prices and leverage that. Or the equity in your home if you own a place now. Your places, if you bought 18 months ago, 24 months ago, are probably up 20%. That's not real, but leverage that. If you're not selling your place, who cares? If you're selling it, of course. But there's companies out there that do lines of credit. There's cash out refinances. Just make sure the risk or the costs, you weigh those and make sure that you're taking educated risk on the other side. That's so important. Don't do something just to do something, but do it smart. do it calculated, and try to mitigate your risk. It's never riskless, right? If it was riskless, everyone would do it, but you can pretty much mitigate your risk as much as possible. Screen your tenants, right? Like, guys, we have Facebook, we have we have we have Instagram, right? You can Google someone's name and you find everything out about them. Please do that. Pull their credit. Ask for a pay stub, a W-2 for your tenants. If they won't give it to you, move on. Because if you're getting a loan with me, you know what I'm asking you for? Your pay stub and your W-2. And if you don't get it to me, I'm moving on. Right? Like, you're a landlord. You're extending someone credit. Be educated about it, and you're going to be great at this. There's bad stories out there for tenants, and there's phenomenal stories too. Just do it the right way, and you guys will be fine. So, anything else? No, that's kind of pretty much it, guys. I kind of touched on everything I wanted to touch on. It's not all encompassing. I'm not going to go like, we need a 620 FICO score. That's for like personal conversations and stuff. But does anyone want to toss out any ideas, any questions they have for me? What do we got?
In regards to the line of credit.
Yep.
Do you foresee the banks getting more tight on lending on? Or even raising some of that?
100%. Yes, I do. And because of the forbearance deferment stuff, that's going to be coming down the pipe. So if you do get a line of credit, even if you don't need it, guys, I would highly suggest drawing on it, putting the money in your bank account. Yes, you have to pay interest on it. I get it. But to have the liquidity, when you sign those 5 pages of a line of credit, it literally states in there, your credit score changes, the situation changes, or they wake up on the wrong side of the bed. It's frozen, it's liquidated, it's cut, it's gone. It's not a right, it's a privilege to have a line of credit, just like a loan is. So literally just, if you get it, draw it, put the bank, they can't make you pay the money back, but they can freeze it for you. But absolutely, I think that's the only way, which is why there's only a handful of lenders that even go up to 90%. We did have a couple in our marketplace that actually went up to 100%. They cut that back real quick after they got their fill. About 85. Because it's just, if real estate comes down 5 or 10%, right, they're basically at 100% financing on that. I don't know if it is, but that's probably their forecast that they are projecting. But yes, definitely cut for sure, or frozen. Any other questions, anyone? No? I like questions, but okay. Oh,
Sorry,
we got
I keep asking questions, Josh.
yeah. Go ahead.
Can you talk a little bit about investment loan scenarios these days?
Yeah. So investment loans. So for any of you who committed occupancy fraud, or I know fraud's an ugly word. You said you're going to live there. You didn't own a place, but you magically never moved in, but now you own a free flat, right? There's probably some of you in this room. Let's just keep it like that. So investment is straight up investment. You can't play the occupancy game anymore, and you need to buy investment property. So this is not including hard money or anything like that. This is solely Fannie Freddie stuff. One unit, 15% down. 2 unit place, 20% down. 3 and 4 unit is 25% down. So if you see really good places out there that are just sitting, there's a reason why. Maybe someone can't get a primary residence loan and they're just waiting for someone to have a 20 or 25% down payment to buy it. We do see those in the market, and that's why they're not selling. The rents might be great, but a straight up investment is typically 20 to 25% down. You get to use the rents you would get in order to qualify, so it helps offset that, but getting that big down payment is very important. You can't get a gift on investment loans. So if you have like friends or family members who want to invest with you, off the record, get that money in your account 60 days before, you get updated bank statements. We don't see it, we're all good. But many of you guys are investors are at that point where you can't play the occupancy game anymore. So it is solely a 15, 20, or 25% down. But that's where it is. There are hard money lenders who allow people to flip, and they'll do some things where they'll lend you based on the future value, and you put down a percentage of that, but there's other risk involved there. Anything else? Any other questions, anyone? No? All right, well, cool. Well, I appreciate it. Enjoy your tape measures. Those are good quality ones in there. I'm very proud of those. It's a new product. So any questions on there, John?
Yeah, no questions here. So awesome. So what I'm going to do is I am going to kind of move us to the last phase, which is just open networking once again. So if you're on the Zoom, I apologize. I'm just going to pretty much just leave it for you guys to network, and you can finish when you finish. And if you're in person, please buy some tacos. They're awesome. And the more you buy, the less I have to pay these guys at the end. So knock yourselves out. Happy networking, everybody. Thank you for coming, Zoom audience. You guys can always get a hold of me. I'll shoot you a number here. We'll continue doing the Zoom component, and hopefully we'll get better at it each time. This obviously was our first time. So yeah, happy networking. Thanks for coming to our Zoom friends.
All right.